The complete guide to refinancing your loans, mortgages, and educational loans. Refinancing can be a powerful financial strategy to improve your loan terms, reduce interest rates, or manage your debt more effectively. Whether you're looking to refinance your mortgage or educational loans, understanding the basics, advantages, and disadvantages of different refinancing options will help you make informed decisions. This guide will explain the essentials of refinancing, discuss the pros and cons for various types of investors, and offer tailored advice based on your financial goals and life stage. What is refinancing? Refinancing involves taking out a new loan to pay off an existing loan. The new loan replaces the old one, ideally with better terms such as a lower interest rate, extended repayment period, or different loan structure. Refinancing can be applied to various types of loans, but the most common are mortgages and educational loans. Refinancing mortgages. Overview. Mortgage refinancing involves replacing your current home loan with a new one, potentially with different terms or rates. Types of mortgage refinancing. Rate and term refinance, cash out refinance, cash in refinance, streamline refinance, home affordable refinance program, HARP. 1. Rate and term refinance. Overview. This type of refinancing changes your mortgage interest rate or the length of your loan term. Pros. Lower interest rates. You can secure a lower interest rate compared to your current mortgage. Shorter loan term. Opting for a shorter term can reduce the total interest paid. Longer loan term. Extending the term can lower your monthly payments. Cons. Closing costs. Upfront fees can be significant, including application fees, appraisal costs, and title insurance. Longer time to break even. It may take time to recover the costs of refinancing through lower payments. Best for new investors. Used to secure a better rate for your first mortgage or reduce your monthly payments. Experienced investors. Ideal for refinancing rental properties or consolidating multiple mortgages. Investors aiming for early retirement. Consider for reducing payments or shortening the loan term to align with retirement goals. Investors near retirement. Used to lower monthly payments or to prepare for a fixed-rate mortgage before retirement. 2. Cash out refinance. Overview. You refinance your mortgage for more than you owe, taking the difference as cash. Pros. Access to cash. Use the extra funds for investments, home improvements, or debt consolidation. Potential tax benefits. Mortgage interest may be tax deductible if used for home improvements. Cons. Higher loan amount. You'll owe more on your mortgage. Increased monthly payments. Higher loan balance could lead to larger monthly payments. Risk of foreclosure. More debt increases the risk of foreclosure if you cannot make payments. Best for new investors. Useful for accessing funds for new investment opportunities. Experienced investors. Can be used for property renovations or new investment ventures. Investors aiming for early retirement. Use cautiously for investments with high returns or to consolidate debt. Investors near retirement. Generally not recommended due to increased debt and risk. 3. Cash in refinance. Overview. You pay a lump sum of cash to reduce your mortgage balance and lower your loan-to-value ratio. Pros. Lower interest rates. A lower loan-to-value ratio can qualify you for a better interest rate. Reduced loan balance. Paying down principal reduces your loan balance. Cons. Upfront cash requirement. Requires a significant amount of cash upfront. Not for everyone. May not be beneficial unless you have sufficient savings. Best for new investors. Less applicable for those starting out unless you have extra savings. Experienced investors. Ideal for those looking to reduce their mortgage balance or improve terms. Investors aiming for early retirement. Used to lower your mortgage balance as part of a broader retirement strategy. Investors near retirement. Good for reducing mortgage debt before retirement. 4. Streamline refinance. Overview. A simplified refinancing option for existing government-backed mortgages, like FHA or VA. Pros. Less paperwork. Fewer requirements and easier approval process. Lower rates. Often offers better terms for current FHA or VA loans. Cons. Limited to government loans. Only available for FHA or VA loans. No cash-out option. Not suitable if you need to access equity. Best for new investors. Applicable if you have an existing FHA or VA loan and need easier refinancing. Experienced investors. Simplifies refinancing for existing government-backed loans. Investors aiming for early retirement. Used to secure a lower rate on your current government-backed mortgage. Investors near retirement. Ideal for maintaining low payments with minimal effort. 5. Home Affordable Refinance Program, HARP. Overview. A government program for homeowners underwater on their mortgages, owing more than the home's value. Pros. Refinance despite underwater status. Allows refinancing even if you owe more than your home's value. No PMI requirement. No need for private mortgage insurance. Cons. Program expiration. The HARP program has expired, but similar programs may be available. Eligibility requirements. Strict criteria for eligibility. Best for new investors. Generally not applicable unless you're underwater on an existing mortgage. Experienced investors. Used for refinancing underwater properties if applicable. Investors aiming for early retirement. Not relevant unless you qualify for a similar current program. Investors near retirement. Consider if you have an underwater mortgage and need to refinance. Refinancing educational loans. Overview. Refinancing educational loans involves consolidating or replacing existing student loans with a new loan for better terms. Types of educational loan refinancing. Federal student loan consolidation. Private student loan refinancing. 1. Federal student loan consolidation. Overview. Consolidates multiple federal student loans into one new loan. Pros. Simplified payments. Combines multiple loans into one payment. Extended repayment terms. Can extend the repayment period. Cons. Loss of federal benefits. Consolidation can result in losing benefits like income-driven repayment plans or loan forgiveness. Higher total cost. Longer repayment terms may increase the total interest paid. Best for new investors. Not typically relevant for those starting out and less consolidating student loans. Experienced investors. Useful for managing multiple federal student loans. Investors aiming for early retirement. Consider if managing multiple loans is difficult. Be cautious of losing benefits. Investors near retirement. Used to simplify payments but be aware of potential loss of federal benefits. 2. Private student loan refinancing. Overview. Replaces your existing student loans with a new loan from a private lender. Pros. Lower interest rates. Potential for better rates than federal loans. Flexible terms. Choice of loan terms and repayment options. Cons. Loss of federal protections. Federal benefits like deferment and income-driven repayment plans are lost. Credit-based. Requires good credit for the best rates. Best for new investors. Consider if you have private student loans and want lower rates. Experienced investors. Ideal for those with good credit looking to lower rates or consolidate. Investors aiming for early retirement. Used to reduce student loan costs as part of your broader financial strategy. Investors near retirement. Useful for managing student loans with better terms if you have good credit. How to choose the right refinancing option. For new investors. Mortgage refinancing. Consider rate and term refinancing to secure a better mortgage rate. Focus on options that have minimal upfront costs. Educational loan refinancing. Evaluate private student loan refinancing for better rates if you have good credit and are managing existing student debt. For experienced investors. Mortgage refinancing. Look at cash-out refinancing for accessing home equity for new investments or streamline refinancing for simpler terms on existing government-backed loans. Educational loan refinancing. Private student loan refinancing for better terms if you have good credit. For investors aiming for early retirement. Mortgage refinancing. Opt for rate and term refinancing to align your mortgage payments with your retirement plans. Consider cash-in refinancing if you have extra savings to reduce your mortgage balance. Educational loan refinancing. Private student loan refinancing can help manage student debt as part of your early retirement strategy. For investors near retirement. Mortgage refinancing. Use cash-in refinancing to reduce your mortgage balance or rate and term refinancing for stable retirement payments. Educational loan refinancing. Federal student loan consolidation or private student loan refinancing can simplify payments but be aware of losing federal benefits. Conclusion. Refinancing your mortgage or educational loans can be a strategic move to improve your financial situation, but it requires careful consideration of your current needs and future goals. New investors should focus on options that provide better rates and manageable costs. Experienced investors might use refinancing to access home equity or simplify existing loans. Investors aiming for early retirement should consider refinancing to align loan terms with retirement plans. Investors near retirement should use refinancing to reduce debt and manage expenses as they approach retirement. By evaluating these options based on your financial situation, you can choose the best refinancing strategy for your needs.